Yo, what if I told you countries want their money to crash on purpose? Sounds crazy, right? But in 2025, Donald Trump's throwing shade at China, saying they're tanking their currency to dodge his 200% tariffs. Why would anyone make their money weaker? And why is the US freaking out? I'm MG, and today we're diving into why countries devalue their currency, how they pull it off, and what it means for you. Stick around, because this one secret from 1985 will blow your mind. Let's jump in. First, let's break it down. Currency devaluation is when a country's government chooses to make its money worth less. Think of it like marking down your old couch on Craigslist. You're lowering the price to get more buyers. This isn't the same as depreciation, where a currency weakens naturally because the economy's tanking or investors are bailing. Devaluation? That's a deliberate move. Then there's currency manipulation, a spicy term the US loves to throw at China. It's when a country messes with its exchange rate to gain an edge, like making exports dirt cheap. Not every tweak is manipulation, though. It gets shady when countries hide it or overdo it. And that's when the cheater label comes out. But here's the kicker. Almost every country, including the US, has played this game. So why do it? Section 2. Why countries want weaker money. Weaker currency sounds like a terrible idea, like burning your paycheck. But in economics, it's a power move. Here's why. Reason 1. Cheaper exports, more sales. Imagine you're China, selling a $10 toy to Americans. If $1 equals 7 yuan, that toy costs 70 yuan in China. Now Trump slaps a 30% tariff, so Americans pay $13. Ouch! Suddenly your toy's not so cheap. US buyers might switch to Mexican or American toys, so China weakens the yuan. Now $1 equals 8 yuan. Your toy still costs 70 yuan, but in dollars, it's just $8.75. Even with the tariff, it's $11.38, cheaper than before. China keeps selling, factories keep humming, and jobs stay safe. That's why countries like China love this trick and cancels out tariffs and keeps exports flowing. For the US, though, it's a headache. A strong dollar makes American stuff like iPhones pricier abroad, and exporters like Boeing lose sales. No wonder Trump's mad. Reason 2. Sneaky protection for local businesses. A weaker currency makes imports pricier. If you're buying a German car in the US, a weaker dollar means you're paying more. That pushes Americans to buy local. Think Ford or Tesla instead. It's like an invisible tariff, without the trade war drama. China's been doing this to boost its own brands like BYD over foreign competitors. Reason 3. Shrinking debt. Kinda. Here's where psychology kicks in. If a country owes debt in its own currency, devaluation can make it cheaper to pay back. Say the US owes $1 million. Print more dollars, spark inflation, and that $1 million buys less than it used to. The government pays back weaker dollars, saving money in real terms. Sneaky, right? But if the debt's in another currency, like China owing dollars, a weaker yuan makes it harder to repay. It's a gamble. Section 3. How do they pull it off? So, how does a country tank its own money? It's not like they just rewrite the exchange rate on a whiteboard. Here's the playbook. Trick 1. Slash interest rates. The Federal Reserve, not the government, controls interest rates. High rates attract investors to US bonds, boosting dollar demand and making it stronger. Want a weaker dollar? Cut rates. Investors ditch bonds, sell dollars, and the dollar drops. In 2025, the Fed's been cautious, but other countries are slashing rates to stay competitive. Trick 2. Print more money. Ever heard of quantitative easing? It's when the central bank prints cash and buys bonds, flooding the market with money. More money equals inflation, equals weaker currency. The US did this big time after 2008, and China's been accused of it too. Trick 3. Play the reserves game. Countries like China hold massive foreign reserves. Think $3 trillion. To weaken the yuan, China sells yuan and buys dollars, flooding the market with yuan. Less demand, lower value. If the yuan drops too fast, they buy it back to stabilize. It's like a high-stakes poker game. And China's got a big chip stack. Section 4. Is it cheating? Now you're probably thinking, this sounds like rigging the game. Is it fair? Well, it depends who's talking. The US called China a currency manipulator in 2019 when the yuan hit 7 per dollar, claiming it was dodging tariffs. China said, nah, just business. The label was dropped in 2020, but the drama's back in 2025. Here's the twist. The US isn't innocent either. Flashback to 1985, the Plaza Accord. The US was losing to Japan's export boom, so it teamed up with Japan, Germany, and others to weaken the dollar. Japan sold dollars. The yen skyrocketed, and Japanese exports got pricier. It backfired, though. Japan's economy tanked into a decades-long slump. Moral? Devaluation's a double-edged sword. It's not cheating if everyone's doing it, but it can spark trade wars or currency wars. Like after 2008, when everyone raced to weaken their money. Too much of it? Global inflation, panic, and broken trade deals. Section 5. Is weak money bad? If weaker currency boosts exports and saves jobs, it's a win, right? Not so fast. Here's the dark side, and it hits your wallet too. Downside 1. Inflation hits hard. A weaker dollar makes imports like oil, electronics, and coffee pricier. In 2025, with US inflation already at 3.5%, a weaker dollar could push prices higher, squeezing your grocery budget. Countries like China, who make their own stuff, handle this better, but the US, not so much. Downside 2. Your paycheck shrinks. If prices rise but your salary doesn't, you're screwed. A weaker dollar means your $50,000 salary buys less. It's why Americans are freaking out about cost of living spikes. Downside 3. Rich get richer. Inflation pushes people to invest in stocks or real estate to beat it. If you've got a 401k or own property, you're golden. But if you're just scraping by, good luck. Devaluation widens the wealth gap, and that's a psychological gut punch. The big risk. If a country overdoes it, inflation spirals and trust in the currency tanks. Look at Venezuela. Their money's basically toilet paper now. Even the US isn't immune if the dollar loses its shine. So there you go. Why countries tank their money, how they do it, and why it's got the US on edge in 2025. It's not just economics. It's psychology, greed, fear, and survival. What do you think? Is devaluation smart or shady? Drop your thoughts in the comments and let's talk. If this opened your eyes, smash that like button, subscribe, and hit the bell for weekly money tips to stay ahead of the game. See you in the next one.